Welcome to Veranda CA. In current session, we will be discussing about model tax convention. We had just discussed about the requirement of tax treaties, right? So when you said tax treaties, we said limited treaties, comprehensive treaties and all those things. So now how is this treaty structured? When we say treaty, we were speaking about exchange information agreement, double taxation avoidance agreement, and a lot about the tax treaties on why it is required, all those things, right? But what exactly is the structure of a treaty? What all does it contain? And what is the requirement for each of the article or each of the structure? How is it actually, what is the content of such article of something? So when you say about these model tax conventions, these tax treaties are basically, we said there are two templates, right? So there, we can call this as template. So when you say template, it's basically you have a fixed structure, like what we see for various purposes in Excel or Word or whatever. You have fixed templates. So this template will have a model which will have each of the articles defined in a particular manner. Now this template, one is based on this OECD model, that is your Organization for Economics and Cooperation Development, and then you have United Nations model. So this United Nations model also has come up with this a template of a tax treaty. So it's more of pick and choose which article you need, what kind of definition you need. So they have given a clear structure on how a treaty must be structured. So while comparing these two, basically 1977 was the first year in which a final draft was introduced with respect to this OECD model, which the latest one is issued in 2017. Generally, this OECD is entered by the model, that is the template created by this OECD, is basically created by two developed nations. So it's something like your United Nations, your United Kingdom, or such developed nations. When they are entering into an agreement, they might prefer this OECD model. So OECD model is primarily for developed nations. So it is primarily for the developed nation, and whatever this treaty is about, we said there are two types of taxation, that is residence and the source. OECD says primary importance is for residence based taxation. So it advocates residence based taxation. So that's the primary importance. It doesn't mean that they don't say that it must not be taxed in source, but it primarily advocates the residence based taxation. It has 7 chapters, that is 7 segments or something, and it is divided into 32 articles. Whereas in United Nations model, it was actually finalized in 1980. The latest one is 2017. It gives you a balanced approach, which means not just developed nation, even developing nations such as India or something can also prefer this model. So they have structured in a manner that it would be helpful not just for developed nation, also for the developing nation. So they have catered a balanced approach. So they have weighted both the developed nations and developing nations equally, and they have created an approach. So it's for all kind of economy, developed, developing, even the underdeveloped or whatever. So all these economy, to have a uniform approach, they have created a balanced template which will apply to all the countries that we are talking about. When you say this OECD is based on residence based, United Nations is based on source based. So more emphasis on source based taxation. So that's the difference. So this is residence, this is source. That's the primary importance. They don't say that it is not taxed in the resident or something. Primary importance is given to the source based taxation. It is divided into 7 chapters. Again, this is also divided into 7 chapters, but it has 31 articles. What do you mean by article? It's like a section. So it has various definitions, content and all these things, right? So for example, one section will talk about definition. So one chapter will talk about definition. Each definition will be called as an article. And similarly, one definition will be about, one chapter will be about taxing a capital gain. What about a capital transaction and other things. So all this are broadly called as chapters. Each of them under the chapter is segmented as articles. So OECD has 7 chapters, 32 articles, whereas UN model also has 7 chapters but 31 articles. Now we will see each one of this. We will just try to briefly explain. Certain important articles are explained independently in subsequent slides, but we'll have a brief understanding of each of this article that we are talking about. So the first one is scope of the convention. So when you say scope of the convention, that is the first chapter. So the first chapter is the scope. What do you mean by scope? Scope is basically the coverage. So when you say the first one, it is about the persons covered. When you say the second one, it is about the taxes covered. So these are the two things that we discussed about. So the first one is persons covered, the second one is taxes covered. So it will talk about for which persons. What do you mean by person? It could mean a company, a trust, an LLP, a firm, or whatever it is. And when you say taxes, it could mean what type of taxes. Is it only income tax? Is it also the GST? Is it about the customs? All these taxes are also discussed in taxes covered. Sorry. The second section, that is the second chapter, is about general definitions. So the third one here talks about what are all the definitions discussed. So in particular treaty, you might have various definitions for each of this. So that definition is discussed here in general definitions. As the fourth article, I am sorry for the disturbance. The fourth article is about the resident. So when you say resident, when is someone called as a resident? What is the scenario that will help someone as a resident? So we discussed about section 6, which talks about who is a resident, who is a non-resident. Similarly, article 4 of this DTA of a treaty discusses about how do you decide someone as a resident or not. So this is similar to what we have seen in income tax. When I say similar, here you don't have basic condition, additional condition and all. It generally talks about how do you determine someone as a resident. We will see that in detail in the specific slide. And next one is article 5, which is about permanent establishment. So what is a permanent establishment? We have already discussed. It is a fixed place of business in which a business is wholly or partly carried on. So in both these OECD and UN, the fifth article is about permanent establishments. It gives you specific business scenarios. When will that be called as a permanent establishment? Let's say a construction business, or let's say what you call a dependent PE. So there are few types of category of business transactions covered in this permanent establishment in this article 5. That we will be seeing that also in a separate slide. And then you have this third chapter, that is the third chapter discusses about the taxation. So it basically tells you each of the income. So we said the primary intention of this treaty is to avoid, eliminate double taxation. So we will try to tell you what happens, like what happens when, where it should be taxed. Should it be taxed in the resident country, or should it be taxed based on the source basis? So this is what discussed, and at what rate. So when you say taxation, it is about where it is taxable. So it discusses about where it is taxable and probably at what rate is taxable. So this is what is discussed there. So where, at what rate, and what are the transactions that are taxable. All this is what is discussed in chapter 3 of this treaty. So both OECD and UN discusses this in chapter 3. The first one is article 6, which talks about immovable property. So what happens when there is an income from an immovable property? Understand the word income, and when you say income, it does not refer transfer, because transfer is what? Capital in nature. So whatever is covered here is only revenue, that is your rental income or lease income or something, some income from an immovable property. So that is discussed in article 6. It is not about capital transaction, it is not about transfer of property. So what is discussed here is only the revenue receipts from an immovable property is discussed in article 6. Article 7 is business profits. So what is exactly a business profit, and when is it taxable in a particular location? So this is what is discussed in business profit. So what is the income that must be taxable? Where should that be income be taxed? At what rate or whatever. So that's what is discussed in this business of profit. We'll see this also briefly in a subsequent slide. And then article 8 in both OECD and UN, it is about international shipping and air transport. So it is both about ship and air that we are talking about. So this transactions. Income from such transactions is covered in Article 8 of OECD and both in the OECD and the United Nations. And then you have 9. What about the transactions with associated enterprises? Who is an associated enterprises? We saw in transfer pricing provisions. So basically, it is a related party concept in a much wider sense. So we said based on the control in management, control or capital. If there is some ownership or something in management, control or capital, then in some way we said directly or indirectly they will be called as an associated enterprises. So we spoke about various scenarios. So similarly, Article 9 tells you what about the transactions with the associated enterprises. So that's discussed in Article 9. 10 talks about dividend. So what about the dividend income? When there is a dividend income in a particular country, where should it be taxed and what rate should be taxed? So that's what is there. And 11 talks about interest. So what about the interest income? Similarly, when you have an interest income, what is the rate of taxation of this interest income? At what rate it will be taxed? When will it be taxed? In which country it will be taxed? So the questions answered are similar. Which country it will be taxed? What rate it will be taxed? What transactions are actually covered here? Are there any exceptions? So what is covered in a particular article is more or less similar. Only thing is there is a specific focus of each of the income as a separate article. As you see, Article 10 is about dividend, Article 11 is about interest, and 12 is for royalties. So in both OECD and UN, Article 12 is about royalties. So what do you mean by royalties? It is about some payment for use of some rights for intangibles or something. There is some payment. It could be because that it is transferred or it is use of some right for which royalties are paid. So this royalty is discussed here in Article 12 here. So that is what is specifically for. But UN additionally has a separate article for fees for technical services. So OECD has only about royalty in Article 12. UN says I have a specific article for fees for technical services in 12A. So that is exclusively covered in Article 12A. 13 is about capital gain. So this is where the transfer comes, transfer of immovable property or whatever. What happens to that capital gain of the share, anything, not only immovable property, what happens to the capital gain of immovable property or the movable property, what happens to that? So that is discussed in Article 13. And then 14, there is no coverage in OECD, it has actually been removed. So the 14 in United Nations, it's independent personal services. So this is also something that we'll be covering it separately in a slide. And then you have 15 called as income from employment. So it is called as income from employment in your OECD, but United Nations it is called as dependent personal services. What do you mean by a dependent personal? A dependent personal is someone who is an employee. So because you are always, there is always a dependence, right? The employee is dependent on the employer is dependent on the employee. So this dependent, so there is a dependency relationship between these two. So that is what you call it as an employment. So almost this employment and dependent personal services are always about this employment category. Because 14 talks about independent, where it is for consultants and independent consultants who are not based with anyone, who are not linked with anyone, they are not an employee or something, they are independently handling a particular transaction. So such is covered in Article 14 of United Nations as independent personal services. So the word is independent here, but Article 15 is specifically for income from employment. In other words, United Nations calls it as dependent personal services. So that is discussed in Article 15. And Article 16 is for directors' fees. OECD talks only about directors' fees, but United Nations expands it not just to directors' fees, but also to remunerations of top level managerial officials, that is the top management. Whatever remuneration is provided to the top management, that is also discussed in Article 16. Whereas in OECD, it is only for the directors' fees. You don't talk about this top management's remuneration fees. So that's the differentiation between the OECD model and the United Nations model. So that is for Article 16. Next one is Article 17. We are still continuing with the chapter 3 itself. So what did we say? For each income there will be a separate article. So that's what we are seeing from 6. Starting from business, we have been seeing one by one article at a time to understand what is that income that is covered here. So we saw 16 is for director's fees, that is an income that a director is receiving as director fees is what is discussed in article 16. So similarly, now we have come to article 17, which is for entertainers and sports person. So the word used in OECD is entertainers and sports person, whereas in United Nations the words used is artist. So probably again, as we said, employee dependent person, we said both are what you call same concept, right? Similarly here entertainer and artist are almost exactly same. Probably there is no difference when you mean someone as an artist. Artist is always a person who entertains. So entertainer and artist, there could be subtle differences, but they are trying to cover a broad category of same set of people. So that's what article 17 is. Article 18. So article 18 is about pensions. Here also OECD restricts only to pensions, but 19 says not just pension, all social security payments. When you say social security, it is basically, it could be anything that supports an employee, let's say provident fund or whatever fund. So anything that can be classified as a social security will fall under this United Nations. So it is any additional fund or whatever covers for an individual. So that is all covered under the social security payment. So that is also covered in United Nations, whereas in this OECD, it is only pension. So it is not about the social security payments. And then you have common thing 19, that is government service in both OECD and United Nations. So what is government service? When let's say there is a service relating to a government organization or something, so such income is covered under government services. And next one 20 is for students. So what are the provisions about students? What happens when a student is actually receiving income or whatever? What type of income? Where is it taxable? So this student's income is discussed in article 20. Anything which we have not discussed still now, that is from article 6 to 20, whatever we have discussed right now, if something doesn't fall under that, we have a miscellaneous section of miscellaneous article of 21, article 21, which is about other income. So there will always be the miscellaneous provision to cover rest of the areas which probably they prefer to cover the intention. So that is, if there is something left out to meet out the objective of the treaty, any other income could be classified here. So that's what you are meaning by other income. So this is what is the total set of income list from 6. So we saw business, from business, and next we saw this income from immovable property, business profits, international shipping and air transport, associated enterprises, dividend, interest, royalty, technical services, independent personal services, capital gain, dependent personal services, that is nothing but income from employment, director's fees, and then you have entertainer and sports person. You also have this pension, social security, government service, and finally you have students, and finally the last article is about other income. So all this put together is about taxation of income. So from article 6 to 20, everything talks about each income. If something is left out, it is covered in 21. So that's a miscellaneous article. So this is what we are talking about, the third chapter of both OECD and United Nations. Moving on, it will be about the fourth chapter. Fourth chapter is about the capital payments. So we are not talking about capital gain, we are talking about the capital payments. So what do you mean by capital payments? It's basically investment. We can call it as, we can take it as investments. Something like your investments. So when you say investment, so this investment, whatever capital investment has been made in a particular country, how do you treat that? So what happens when you are actually making an investment in the particular another country? So that's what you are calling it as a capital investment. So that is discussed in section 4, that is chapter 4. Chapter 4 of this treaty, both in OECD and United Nations, has only one article, which is article number 22, which talks about capital investments made in a particular country. How is this treated? So we call something like tax havens and other thing, right? So just to evade tax, you invest in a particular country because the treaty says that whatever capital you are investing, that income out of that is not taxable. Probably it might completely escape tax in both the countries. So there could be a scenario like that. So capital investments primarily tells you what happens to such investments, about the income generated in that or treatment of such capital. What is it has to do with that between both the countries. So that's discussed in section chapter 4 called capital. And then you have the section 5, which is about the method, that is for basically let's say it's something like your foreign tax credit, right? So we said there are two methods. One method is the exemption method. So article 23A talks about exemption method. So what is an exemption method? It is taxable in one country, not taxable in another country. Let's say country 1, it is taxable, country 2, it is exempt. So that is what called as exemption method. So it is taxable in one country, exempt in other method. So that is what country 1, country 2, taxable in country 1, exempt in country 2. So that is discussed in article 23A. How is that provided? Is there an exemption method for a particular income? In case if it is there, how is it provided? So that is what discussed in article 23A. 23B is about credit method. What is credit method? C1 tax that income, C2 takes relief. So it takes a relief of a certain percentage. We saw in section 91 where we said how is this credit calculated. You take the average rate of the Indian income tax rate for the entire income after deductions and relief. Then you identify the foreign tax rate of whatever has been charged in that particular country, whichever is lower. To that extent, that proportion of tax is basically taken as credit. A relief is given for such proportion. So this is what discussed in the section 91 about relief being given. So we saw 90, 90 and 91, where 91 provides for this relief, whereas 90 says depending upon the DTA you can take credit. So DTA will either provide article 23A for exemption method or article 23B for credit method. So one of this needs to be followed. So that is provided in 23 and 23B. So this is the method for eliminating double taxation. If you actually remember, when we started, we said, when we discussed about this treaties, the role and need, we said not necessarily for elimination of double taxation. So typically only this section 5, chapter 5 talks about how do you actually eliminate double taxation, or probably even the section 3 to an extent talks about elimination of double taxation. Probably the rest of the things what we are going to see subsequently is not necessarily related to double taxation. It is something else. It is something more than double taxation. If you actually go ahead, there are some, chapter 6 is called as special provisions. So these are not specifically for eliminating double taxation. So it is not necessarily for eliminating double taxation. So this is one of the role of treaties that we saw. So that we are going to understand through this chapter 6. So we are going to see certain provisions which are actually not for double taxation. So the first one there is 24, which is called non-discrimination. We have discussed this several times. What did we say? We cannot discriminate a non-resident and resident in a treatment. So article 24, both in OECD and UN, stresses the fact that taxation cannot be biased. So whatever taxation you are talking is for a non-resident, should also, that whatever you are talking for a resident should also be there for a non-resident. So resident must be equal to non-resident. Just to repeat, section 90 provides an explanation saying tax rate of a foreign country, that is tax rate difference. So foreign country versus Indian company. So foreign company versus Indian company, or probably non-residents versus resident. So this tax rate change does not mean discrimination. So this has been provided in section 90, right? So this very clearly says just because there is a change in rate between a non-resident and resident does not mean there is a discrimination. If you actually see, foreign company is taxed at 40%, Indian company is taxed at 40%, Indian company, let's take 25%, it's taxable at 25%. So there is a bias, so there is a discrimination, but Income Tax Act through section 90 says this is not discrimination. So just because there is a change in rate does not mean there is a discrimination. Similarly, if you actually look at it, even in individuals, the senior citizen additional slab is not available for non-resident. Again, there is a change in tax rate for resident or non-resident, that is not discrimination. So that is Article 24. Article 25 is mutual agreement procedure. We call this as MAP. So this is basically there is certain decisions made between these countries on deciding various disputes or various tax scenarios. So that is made through this mutual agreement procedure. So basically countries can help in arriving at a mutual agreement procedure for entities to determine tax treatment of a particular transaction or several transactions. So that is called as mutual agreement procedure. Something in line with advance agreement pricing that we discussed. Whatever we discussed was advance agreement pricing, right? So whatever we discussed, that is similar to MAP. So that is what is MAP. There is a separate article for mutual agreement procedure which is entered between countries. So that is what when we said advance pricing arrangements. So this is basically advance pricing arrangements. Advance pricing arrangements. So in advance pricing arrangement, we said when we are talking about it, we said it could be unilateral. That is, India alone can enter. But MAP is always bilateral. But two countries will be involved in getting a MAP. But APA can be unilateral also. So this Article 25 provides the ways or probably gives a direction of this concept of mutual agreement procedure that is discussed in Article 25. Moving on, 26 talks about exchange of information. So what is about exchange of information? In what circumstances information can be shared between one country to another country? In what circumstances or what information can be shared from one country to another country? Can they share whatever someone asks for? Please give me PAN of all the assessees that you have in India. Is this possible or not? So this exchange of information tell you what information is shareable and what is the process of sharing such information. So this is discussed in Article 26. When you say process, it will not be detailed. It generally gives a directions for exchange of information. To give impact to that, certain rules and sections will be incorporated in the Income Tax Act to facilitate this exchange of information. And then you have Article 27, which is about assistance in collection of taxes. If you actually see, this entire chapter is OECD is same as United Nations. So there is no difference at all. Only in the taxation of income you had differences. But in all these sections, that is all these chapters and articles, if you actually see, chapter 6 has various articles from 24 to 30. Everything is similar. Whatever is there in OECD is also there in United Nations. But of course, the content might slightly differ. The important articles we said we will discuss it in the slide, where we will understand what is it discussed in OECD, what is it discussed in United Nations. So coming back to each of the articles, Article 27 is about assistance in collection of taxes. So again here also it tells when can a tax due from a foreign assessee be collected, foreign taxpayer, how can it be collected or when can it be collected, what is the guideline. Again, everything of this thing gives you a direction, a guideline in facilitating exchange of information, facilitating collection of taxes. So that's what you are meaning by Article 27. And then you have Article 28. It is specifically for this consulate. So you have, if it's a treaty between India and US, there will be a US consulate in India, Indian consulate in US, and there will be various diplomatic officials in the ministries and other things. So what is the procedure of this diplomatic missions and consular post? So that is discussed in Article 28. So what happens to such post and profile? So that is discussed in Article 28. So importance is given to officials being exchanged from one country to another country. What happens to certain guidelines on such appointments or whatever. And then you have 29, which is about entitlement to benefits. So certain treaty benefits, the power of transferring that benefits to the assessee is given through this Article 29, which provides for this entitlement to benefits. So when is someone entitled to various benefits in that particular, based on the treaty, treaty will say in so and so circumstances the benefits will be entitled, someone will be entitled to certain benefits on so and so circumstances. So 29 is about the benefit clause, some treaty benefit clauses provided in 29. It is something similar to what we discussed, something like protocol, but not exactly the protocol. But protocol also provides certain clarity, and we also said some benefits might be provided through protocol. This is not exactly a protocol, but something like that, some form of benefits will be transferred through this article 29. And then you have 30, which is about territorial extension. Here there is a difference. This is the only section which has a difference between your OECD and United Nations, where 30 talks about territorial extension, whereas 30 in UN talks about entry into force. Whereas here the entry into force is discussed in this particular chapter 7. So that's the only difference primarily here. So this territorial extension is to say if there can be expanded to various other territories of a particular country, it will be provided to this Article 30. So additional powers in additional territories is discussed in Article 30. This entry into force which comes in this chapter 7 is basically about from when is this treaty applicable. So the effective date of implementing this treaty is discussed in Article 31. And then in Article 32, you have clauses for termination. So that is here discussed in OECD in Article 31. So Article 31 talks about what are the scenarios, what are the situations a tax treaty will be terminated. We spoke about in Vienna Convention where we said taxation termination in case of breach of a particular thing, where there is a faulty practice, something has not been practiced properly in a treaty. So there are certain reasons why a treaty can be terminated. Apart from the reasons listed in that termination clause, there could be no other reasons through which an article, through which a treaty could be terminated. Only for reasons stated in Article 32 of OECD and Article 31 of United Nations, only for such reasons an treaty might be terminated. Otherwise, it cannot be terminated. So these are the entire set of articles, chapters and articles of both OECD and United Nations. So there are 7 chapters, 32 articles in OECD and 31 in United Nations. So that's what is being discussed here in this type of what is the content of this model tax convention. Moving on, we will understand each of this specific articles. We said we will understand some of the important articles in detail. So now what we are going to understand is about Article 4. Article 4 is about residence. So the second chapter which talks about definitions, right? So in that we have Article 4 which talks about residence, definition for residence. So how is a residential status determined per the United Nations, per the OECD? So in these two templates, how is it decided? We will first see based on United Nations. United Nations, this residence is determined based on domicile. That is, domicile is typically where they are placed, regularly placed, their home, their base country. That is what is called as domicile. And next is residence. Residence is typically where they usually reside. So domicile is like something like place of birth, whereas your residence is regular place of where you actually live. And incorporation is, of course, we all know the place in which that particular organization is incorporated, established. So that is place of incorporation. And then you have place of management. This is something like poem. So we need to understand where is the effective management sits. So that is what you call by place of effective management. So that is discussed here. Any other similar criterion, and does not include source. So here when you say residence, it is only based on residence determination, and here source is not discussed upon. Just because there is a source in a particular country does not mean you will be a resident there. So they are excluding. Source is not a point of factor to determine the residential status. So what determines your residential status is your domicile, residence, place of incorporation and your place of management and any other similar criterion. In OECD, everything what has been listed here is applicable but for place for incorporation. So as far as OECD is concerned, it is domicile, it is residence, place of management and any other criterion. It does not include the place of incorporation listed in OECD. So this is not applicable in OECD. So that's the only thing which is not applicable. Next one, when we speak about this residence concept, we need to understand how many days are there in a year. So it's a very basic question, right? So it could be 365 or 366. For illustration purpose, we'll keep it 365. Now, a person has lived in a particular location in 183 days and 182 days, right? So in this situation, there is a scenario that will be called as resident in both. So let's say this is India and this is, let's say, Australia. So resident in Australia. So this person, because he has resided 183 days in India and 182 days in Australia, he will be called as a resident in according to the laws of both the countries. This is only an illustration, okay? So now, once you have been treated as a resident in both the countries, you will have to be treating yourself as a resident in only one country. You can be a resident in both the countries for tax purpose. But for the purpose of this tax treaties, the term residence can only be one for the purpose of tax treaty. So this is general tax, right? So let's say this is tax law. But for a treaty, you could be only one resident. That is, you can be only a resident in one country, not in two. Now, how do you determine this one when situations arises like this? This is 183 days in India and 182 days in Australia. How is it possible to determine in accordance with the treaty? So here what you say is, first factor, see where is your permanent home. Let's say you have a permanent home in India. In Australia, you go and stay only in the hotels. So in that case, when you are only staying in a lodging place in Australia, when your permanent house is in India, it automatically be called as a resident here in India. So let's say it is like home versus lodge. So in one country you have a home, in another country you are only staying in a lodge or a, let's say, a temporary place, a guest house or something. So this is one of the criteria in which it decides, that is permanent home. The second condition is your vital interest. Now what happens if you have a home, let's say in both countries, so in India you have one home, in Australia also you have one home. In both places you have a home. If you be here in India, you live in this home. If you go to Australia, you live in this home. So it's again a tiebreaker, right? So it's again mutual. Now you are not able to decide in which country you are a resident. The second condition is about the vital interest. When you say vital interest, it is about your primary income source. Primary income source. So in which country you receive this primary income? So where is the primary income source located? Is your main activity? Let's say you have a business. In India, you have business. In Australia, you deal in shares. Now, your primary activity is business. So this becomes your vital interest. Your factory is located in India. Your business place is located in India. In Australia, you just do shares. It doesn't matter from where you are actually transacting also. So now your vital interest is in India. In that case, it becomes India becomes a residence. Now, what if, let's say this is not share, you have a business here also. So you have equal vital interest. You have a business in India where you are spending 183 days to take care. You are spending 182 days in Australia to take care of that business. So both are vital interest. Again, there is a tiebreaker. So if it is tie, you move to this. If this is also tie, you move to this clause, the third clause, that is habitual abode. What is habitual abode? Now they say habitual abode is basically a place where you generally stay, where you generally go and stay. That is, you have a home in both the places, but where do you usually prefer to stay? Where do you generally go and stay more often? In India, you go to your house itself. In Australia, let's say you don't go to your house actually, you go somewhere else or whatever, and you keep traveling. So your habitual abode, if it is in India, then, so it is like something like regular or generally stay. So this is you try to identify this particular concept. Where do you regularly stay or generally stay? If this is identified, then such location will be called as a resident. If not, so this is the third step, right? If this is also a tiebreaker, that is, when you go to India, you stay in your house. When you go to Australia, you stay in that particular house. If it is a common place, then if you are not able to distinguish this habitual abode also, there is a tiebreaker there also. Then finally you go to, that is not even finally, you go to fourth step, which is called as nationality. Which national you belong to. Now you could be a person of Indian origin, but you could have applied for a green card in US and you would have obtained that, and you might have a valid US passport. So though you are a national of India, you also have a valid citizenship of this particular American citizen. Now in this case, there could be a tiebreaker also. I am actually a citizen of, like, dual citizenship, right? So if you are able to decide the national, it ends there. That becomes your resident. Now if it's a dual citizen, if it's a dual citizenship, so you are a citizen in both the countries, so your nationality could not be probably decided, or if there it's like it's a equal national. So in that case, what happens is there could be a tiebreaker here also. So there could be a tiebreaker in fourth situation also. In that section, in last, moving on, the fifth chapter is by mutual agreement, that is through discussion. Both the countries, let's say it's India and Australia, both India and Australia, the revenue officials of both India and Australia, the competent authority of both India and Australia discuss and decide which country they will actually belong to, for which country they will be called as a resident. So for tax treaty purpose, you follow these 5 steps to determine the residential status, whether to treat someone as a resident or not. In each of the step, if you actually find an answer, you stop there. Only when there is a tiebreaker, you go to the next step. So it is in this order. So it's not, you can't take an order in whichever you want. First to go and see which national. So that's not allowable. The first starting point is a permanent home. Only from there it actually starts. So this is a orderly step. So it's an order. We can't change sequence. So can't change sequence. So this is the order in which you will have to check. In this order, wherever you have satisfied, you stop there. If you are not satisfied, you move on to the next set of next criteria. So that's what this resident is about. So now we will move on to the next article, which is important, Article 5, that is permanent establishment. Very critical to determine business income, right? 9.1. I have been repeating this section quite often. Discuss about business connection, significant economic presence, which is in line with the concept of permanent establishment discussed in Article 5. So what does Article 5 or Income Tax Act, that is 92F Clause 3 defines PE, right? Chapter 10, 92F, this Clause 3 defines this, what is a permanent establishment. Similarly, in DTAA, P is defined in Article 5. So we will refer to as Article 5. Article 5 defines PE. So we have defined this many times. We have been telling the definition quite a many times. So basically, a permanent establishment is something, a fixed place of business where a business is wholly or partly carried on, right? So this is what permanent establishment about. Now this Article 5 also provides various locations which can be called as a permanent establishment. We said a factory, a warehouse, an office, a branch. So we have been discussing about all these locations which will be called as a permanent establishment. All that are listed in Article 5. Apart from this, Article 5 also provides certain situations for certain business activity when it can be called as a permanent establishment. For example, for a building site, that is a building site or a construction or installation project, OECD says if it is more than 12 months, treat it as a permanent establishment. But United Nations says if such project actually includes assembly and installation or supervisory activities which last more than 6 months. So, OECD says 12 months, whereas your United Nations says 6 months. So, whichever country is adopting a treaty, if they are following a OECD, in Article 5 they would have quoted this 12 months. If they are following United Nations, then they would have followed 6 months. Now, when you have been talking about this difference, you might have a doubt, which treaty does India follow? Which template does India follow? India follows, depending upon the other country, India follows a template. For some countries, India follows OECD. For some countries, it follows United Nations. But it is not a fixed thing. So, depending upon the country, India decides whether it is a OECD or a United Nations. Coming back to this permanent establishment, the next concept defined is service PE. What is this service PE? So, basically whenever there is a permanent establishment with respect to service, so it is not relating to manufacturing, it is related to services. So, this service PE is not defined in OECD, is not explained in OECD, but United Nations says if it is a consultancy service, through an employee, it could be one employee or multiple employee, through employees for more than 183 days. So, it is something like 6 months. So, UN says, see, if you are sending an employee to another country, letting him stay there for 183 days or more than 183 days, then automatically they become a service PE of that particular entity. So, this is what is defined for service PE in United Nations template. If you had followed this OECD template, it is not defined here. It is not available in that particular concept. The concept is not available in OECD. Next one is insurance business. Again, this is not defined in OECD. What does your United Nations says? Collects premium in other state. So, collects premium in other state. So, if it's between India and United States, let's say India is collecting premium from United States, or the risk is situated therein, the property or the let's say call it as object, the object is situated in that country, then that premium becomes a permanent establishment. So, that country will automatically become a permanent establishment because premium is either collected there or the base object of which is being the risk is insured, that is located there. So, then in that case also this insurance become a permanent establishment as far as this United Nations concepts go. The next category, or probably the last category defined in, specifically in permanent establishment, is this dependent agent. While understanding this business connection, we basically learnt that certain relationship between principal and agent are called as a business connection, and certain scenarios it is not called as a business connection. So, while discussing this, we understood this concept when an agent is independent. Independent agent. When is he independent agent? He is an agent for principal 1, principal 2, principal 3, because this activity is in the ordinary course of business. So, if whatever he is doing is handling multiple agencies and in ordinary course of business he is being an agent, they are not business connection. This is the definition provided. This is the this is the section, this is as per the section 9 what it provides for the purpose of business connection. But here dependent agent is discussed in both OECD and United Nations. It basically says, similar to what business connection says, the word habitually is what is there in Income Tax Act also. So, generally, when you say habitually, generally, usually, generally, these are the words that can be replaced with this word habitually. So, when they usually conclude contracts or usually play the principal role to conclude contracts, if you remember business connection what we discussed, we said if on behalf of the principal, if you are allowed to conclude contracts, there is a business connection. So, similarly here also it says if you are habitually concluding contracts or habitually playing the principal role for concluding contracts, then such will be called as dependent agent. So when you are concluding such contract, they say without material modification by the enterprise. So whatever it is, you are automatically going on your own, accepting the contract and proceeding. You have that power to conclude contract. So in that case, you will be called as a dependent agent. So if you are a dependent agent, you become a PE to such principle. So that's what is discussed in both OECD and United Nations for Article 5. So with that, we have now seen what is a resident and we have seen what is an Article 5. Now this Article 5, that is PE, Article 5 PE is critical for Article 7. Why? It is critical because just because you have some business transaction in another country, you will not be taxed in that country. For example, if there is an organization, a company in Australia, they are transacting in India, they are making certain transactions. Since they have a transaction in India, will that be called as business profits? No. So that is where this Article 5 comes into picture. So the right, when you say residence based, source based, right? So now we spoke about a transaction, Australian entity as with Indian entity. Now Australia, they are a resident in that country. To be taxed in India, to tax, treaty must say source based taxation. So treaty must say such transaction will be taxed on source based. Such transaction will be taxed on source based in India. So that's what they say, right of source state to tax. So for the source state to tax business profits, it exists only when PE exists. So unless you have a PE, you cannot tax a business income in the source state. So this is what Article 7 provides, both in OECD template and United Nations template. So uniformly, this is a uniform principle where a business profit cannot be taxed in another state unless a transaction is happening through a permanent establishment. So that's what it says. Just that in United Nations, they are using this force of attraction rule, that is limited force of attraction, which means only to the extent income is attracted in a particular country, you could be taxed. Similarly, OECD also says you can only tax to the extent profits are attributable to the PE. You cannot tax, let's say Australia has a total income of 100. Their sales, let's say Australia's sales is 80 in Australia, 20 in India. So let's say this 20 in India is through a PE. Now India can tax only to the extent of 20. They cannot go and tax that 80 because that is not happening in through Indian PE. So only to the extent of it is happening through this PE, only to that extent it can be taxable. So taxed only so much of profits that are attributable to that PE, not just, there are two more situations also. Basically, when you are selling goods, when the sales is through PE, and the sales in that state, that is you are selling in India through that PE. Similarly, any other business activity carried on through that PE. So if it's a sales, it is through that PE. If it is any other business activity, it is through that PE. So only if it is the income attributable to that PE or income through that PE, only in these two scenarios, the business profits could be taxed in the source country. So in residence, there is no confusion at all. If you are an Australian company, your entire income, irrespective of whether you have earned it in India or Japan or France, it is still taxable in Australia. But if you are transacting in India, it can be taxed in India, the source country, only when such income is attributable to the PE, either directly to the PE or through the sales made through that PE or any other business activity through that PE. Only then it is taxable. So that's about Article 7, business profits. And next one is Article 11. Article 11 is interest. So what does it say? When you talk about this interest, you might have a legal owner, a beneficial owner. So it says, if the beneficial owner is a resident of other contracting states, so they typically say the one who is actually receiving money, that is one who is actually earning income, if is a resident of other contracting state, the tax surcharge cannot exceed the percentage of gross interest. So there must be a percentage which is understood between the countries. So only maximum of that percentage can be taxed in the other contracting state. So the contracting state, when you say contracting state, the entire treaty will have two terms: contracting, other contracting, right? So this is how it will be defined. Now when you say a contracting state, that is let's say US is lending loan to India, who's paying interest, right? Now US becomes the contracting state, that is your resident, right? Residence based. Now India becomes the other contracting state, and here it can be taxed only on source. So in contracting state it shall be taxed on residence basis, but in other contracting state it shall be taxed on source basis. So here whatever interest that entity is paying to the other entity, so this beneficial owner, if he is a resident of other contracting state, the tax surcharge cannot exceed a percentage. So if there is a beneficial owner in the other contracting state, then it can be taxed. So this contracting state and other contracting state are the two parties, two countries involved. So that's what you mean by contracting. And this need not be fixed. One time US might be a contracting state. In other scenario, India could be a contracting state. So let's not confuse much. So as of now, we'll understand the interest could also be charged in the source country. Interest could also be charged in the source country. In such a case, OECD says such rate cannot be more than 10%, whereas United Nations says you discussed between those countries. When you are entering into a tax treaty, you both discuss and come out with a particular tax rate. And whenever there are any penalty charges for late payment, not considered as interest. So that will not be considered as interest payment under Article 11. So that is Article 11. Next is Article 13. This Article 13, capital gain does not discuss about how to compute. So it does not say how to calculate sale consideration, how to compute net sale consideration, index cost of acquisition, index cost of improvement, short term, long term. Nothing of this is discussed in Article 13. Article 13, then what does it say? Article 13 generally says that a particular capital gain income from a capital gain, where should this be taxed? Where should be this taxed? So basically it says rights. The basic rights is provided to the source state. So if the property is in India, the right is given to India. If the property is in US, the right is given to the US government. So that's what is there. But when they say source state, they say more than 50% is derived from the source state. So if it is a property, there is no doubt. If it's in my name, the property itself is in India, then even though I am in Australia, since the property is situated in India, automatically I am liable to pay tax, because the entire income that I am receiving from that property is coming from that property which is located in India. So more than 50% is derived from that particular location in India. So the source state, that is the Indian state, has the power to charge tax on such transactions. So this is what they are referring to, Article 13, capital gain. The next article is royalties. So basically Article 12, royalty. With respect to OECD, they say that whatever is arising in the source state shall be and beneficially owned by the residents of resident state shall be taxable later. So now let's say India, US is providing some the rights on intangible, for which India pays royalty to US. So now, since the person who is there, let's say A Inc. is basically a resident of US. So Article 12 in OECD says, so typically this royalty must be an income only in US and not in India. So that's what they say, arising in source state, that is India, and beneficially owned by the resident of the resident state, that is beneficially owned by a person who is resident in US. It shall be taxable in latter, that is it shall be taxable only in resident state. So such royalty should only be taxed in your the resident country, not the source country. We said OECD gives importance to residence based. But now let's come to United Nations. What does United Nations says? United Nations says a source state may also tax royalties, rate to be determined through bilateral negotiation. So whatever we are talking about can be determined. So now they say India can also tax royalty, and certain definition, the rental for films or tapes, all of this is provided. What all is also included as royalty is defined also in this Article 12. So that is what is defined in source state may also tax royalties. So now moving on, Article 12A. So where it is not provided in OECD. So basically this fee for technical services will be taxed in resident state only, but it does not provide exclusive rights. It says it shall also be taxed in the source state. So the preference is resident state, but it shall also be taxed in the source state. So rate shall be decided. Most of the OECD, most of the United Nations template says that rate shall be determined through bilateral negotiations. So and it excludes what is covered in this dependent personal services. So whatever is covered in dependent personal services is not covered in this particular article. And similarly, payment for teaching in an educational institution is also not covered, and similarly services for personal use is also not covered. The next article we are going to discuss is independent personal services, which is also deleted from OECD. So what do you mean by independent professional services, personal services? We said it is something like a consultant. So it's a professional services. It shall be taxable only in resident state. But this also, similar to royalty, technical services, everything, it shall also be taxed in source state. It shall also be taxed in source state if the provider has a fixed base. It's something like PE. So they are saying if you are rendering in India more than 180 days, then 183 days, then in that case, India can also tax this particular independent personal services. What all is included in independent personal services? Scientific, literary, artistic, education or teaching. And artist athletes are not covered because they have an exclusive article. They have a specific article to tax for artists and entertainers. So they are not covered under this Article 14, though they are independent. And the last article is other income. In the income category, in income chapter, the last one is other income. OECD says residence, United Nations says source based. So there is nothing much to discuss about that other income, and rest of the thing, that is special provision, we will discuss only few special provisions. So one is MAP, that is mutual agreement procedure. It is purely because of dispute resolution. When two entities or two countries have a dispute in taxing a particular transaction, they may enter into mutual agreement procedure to decide on how to tax such particular transaction. United Nations says if you are not able to come to a conclusion within 3 years, you might raise an issue for arbitration. Let us take it up to the court and arbitrate, negotiate and then decide. OECD says if you are not able to complete it within 2 years, you can go for arbitration. United Nations says arbitration must be requested by one of the competent, either of the country must request. But OECD says whoever started this map, they only have to write it and request for the particular dispute. So that is Article 25. Article 26 is exchange of information. So now a contracting state. So now we said exchange of information is permitted. We also checked whether all the PAN, give me all the PAN of all the assessees including the Aadhaar numbers. Is this possible by the Indian government? So now they say a contracting state cannot be able to provide confidential financial information. So they will provide only to the extent it is required, and that too they will not provide when it is confidential financial information. So in case they have to give a confidential financial information, they will have to have a trust on that other country saying that such country will not disclose it to any unauthorized person. So it is limited only to let's say country A is giving to country B. A must have trust on B that B will not give it to anyone else. So only then they can give it to B. So that is exchange of information. So with this we have covered all the relevant articles of model tax conversion and completed the entire chapter of model tax convention. So thank you for the wonderful session.
Light face oil.